And joining us now, a partner at Element Wealth, Jeremy Nelson. Jeremy, good to see you. What a crazy few days we've had here in your world for sure, huh?
Yeah, it's definitely disrupted my vacation a little bit.
Well, that's where I was on vacation, and this stuff broke, and so much information to consume, so many details, so many nuances, so many dynamics that are figured into this, and at a time when we already have a Fed that seems to be kind of unsure, honestly, about their action, what their next action should be. We've had an investment community, I feel like, that's just been an army of Fed watchers, and now they've all been turned into bank watchers. What do you think?
Yeah, that's a really good point. Look, the Fed screwed up, right? And left rates way down way long, right? So they left rates at zero when there was inflation. They should have been much more aggressive in what they were doing, in raising rates and getting off the stimulus. And then all of a sudden they were forced to go really, really fast. And we see Silicon Valley Bank, a bank that had been investing in long duration securities, get forced to go ahead and liquidate a lot of those securities while they were down, taking $1.8 billion in losses, thus needing capital. Then all of a sudden they get $42 billion in deposits pulled out over 48 months, and wham, right? And this really goes to show the speed at which things can happen today, right? I mean, if you think about back when Washington Mutual, right, which was the biggest bank to implode back during the financial crisis, it was like $18 billion of withdrawals over the course of, I think it was like 2 to 3 weeks. Here we're talking about $42 billion of withdrawals within 48 hours, right? So I think that the issues that are going on with Silicon Valley Bank, with Signature Bank, Silvergate, week before last, these are not indicative of the broader banking sector, right? Of your normal, regional banks that we deal with in Mississippi. This is indicative of, like Silicon Valley Bank. Less than 10% of their deposits were covered by FDIC, right? These were just, tons of venture capital flowing into these banks and sitting there in deposits. So, you're not looking at runs on the banks where we live because the vast majority of the deposits are covered by FDIC insurance.
Yeah,
And
we don't have. That's right. Our banks are just not flush with a bunch of customers, business customers included, that keep those kinds of balances in their accounts or any single account.
Yeah. And I think that the response was interesting. Look, let's be real. It is a bailout, 100%. There is going to be cost that's going to happen to, the average person, because it's going to be there's going to be increased FDIC fees or whatever it might be down the road. So it is going to be absorbed throughout the system. But I think that the actions that have been taken from the Fed, the FDIC and the Treasury jointly, definitely stabilize the banking system here. And this might end up being something kind of like that, the banking crisis of, 1907, right? Where all of a sudden everyone freaked out and then it all settled down ultimately.
I'm going to make a prediction and ask you to comment on it. Mm-hmm. That the FDIC will be restructured such that 100% of all deposits are insured.
I actually don't disagree with that, because that's essentially what happened here, right?
It did, but it was somewhat by force and of the Treasury, and then a backstop facility from the Fed. Though at the end of the day, it's the member banks who are absorbing most of these costs, which makes their operating costs go up. But my concern is, Jeremy, that we're going to see some move to just add additional protection and eliminate this $250,000 threshold of insurance so that all deposits are 100% insured, which is going to require higher premiums on the part of member banks to cover that, to increase coverage, essentially.
Higher.
Yeah,
well,
which is going to be passed on to us, the consumers.
Exactly. That's my point. Who's going to end up paying for this? Well, we are, right? I mean, the banks they've got to be profitable entities in order to provide the service that they provide. So
sure.
Yeah, I it'll be interesting to see. I don't think that the FDIC is going to be reorganized in the next month or two. I think this is something long term that's going to have to be looked at. And look, maybe they just take. I mean, the 250,000 has been there for a long time, and at worst, they have to increase that limit to give the average consumer confidence that their deposits in their bank are safe.
Yeah, I think that's totally the case. Have you done any research or reading on what appears to be an overly cozy relationship between this bank, this commercial bank, and the venture capital and private equity community? I mean, this is fairly unique. You don't see this kind of relationship the way you do here, where there are our customers and our depositors and our borrowers all kind of simultaneously.
Well, I mean, everything in this bank was so concentrated, right? The customers, right? Who they were lending to, the depositors, everything was VC, crypto, et cetera. And that is very, very unique. I mean, if you go around and you look at the banks around where we live, they've got very diverse groups of customers, right? And so if there's stress in one industry, it's not taking the whole bank down. And I would use the example of, what happened in 2014, 2015 in the energy market, which affected us more, in Mississippi. So what you saw was all of a sudden there was some defaults that were happening within the energy market. But because our banks weren't completely concentrated in energy, they were hit by it, but they weren't taken down by it. Whereas here you've got Silicon Valley Bank and Signature Bank, who they're 100% VC and crypto and all this, this new age stuff. And all of a sudden winter came in that industry and boom, right, down they go.
Yeah, so true. What happened to just the standard asset-based lending that's typically found in a commercial bank? There didn't seem to be like a lot of assets behind the scenes that collateralizing these loans.
No, look, and really what they were doing is they were just gathering up massive deposits, right? And then they were investing them in long-term securities.
Yeah.
And all of a sudden, when the Fed had to go up, hey, look, we've talked about this on the show before, right? In 2022, the Bloomberg U.S. Aggregate Bond Index was down 13%. So, you know, the longer the term of the bond, right, the more it was down last year. So as rates are going up and up and up, bonds are going down. Well, all of a sudden, they're forced to sell them in the open market at massive discounts, leading to that $1.8 billion loss that they took.
Yeah. It seems also there's been some reports of outflows, some kind of minor runs on some of the non-SIB banks and into the SIB banks. So the Bank of America's, Goldman Sachs, J.P. Morgan's are kind of winning as a result of this.
Well, the winners in all of this are going to be the big banks.
No doubt.
Because they are the ones that are already going through the systemic testing and are under much higher regulation. And, there's a comfort level that, hey, like they're going through these stress tests. The stress tests are made public. We know exactly, how sound they are. We know what the FDIC is doing when they're looking at these banks. And they're going to be the winners in all of this. But I also think that there's plenty of opportunity within some of the other regional banks that are out here that are being hit, that don't have the same issues. So I think ultimately for investors, there's a lot of opportunity here. but you got to do a little bit of homework to see, what's good, what's bad right now.
Yeah, totally agree. We're up against a break. Can you hang around with us? I know you're on vacation, but we got a little bit more to
Hey,
talk about.
anything for you, Gerard. Anything
I
for you.
appreciate that. That sounds great.
All right.
Jeremy Nelson, partner at Element Wealth, is our guest. We've got Jeremy Nelson, partner at Element Wealth, joining us today, apparently on vacation, and we appreciate you calling in, Jeremy, on this important day. So, speaking of doing a little wealth management, market's selling off today over concerns about a banking contagion. What is really fascinating about today's sell-off to me, Jeremy, is that we got fairly good news on the inflation front this morning, with the PPI coming in lower than expected and retail sales being down, which is actually good news from a Fed perspective, because the Fed's looking to kill jobs and kill demand. So they get it with retail sales. They're looking to tame inflation. They get a positive PPI report along that front. They're meeting next week on the 22nd. So I think typically on this day, absent this banking meltdown, we'd have seen markets go through the roof thinking, hey, Jay Powell's got a reason now to pause perhaps and moderate his aggressive interest rate strategy. But instead we get a sell-off because we get Credit Suisse talking about problems this morning. What do you think?
Yeah, look, there's going to be more banks that are going to come out that are going to have issues here, right? And so I think that what this ultimately does is it increases the probability of the recession that we've said is probably coming in the second half of this year. Now, from a rate perspective, ultimately, I think you're right. This is kind of some good news because the Fed is going to slow down now. We were increasingly seeing 50 basis points, priced into the market for March. I think that's got to be off the table at this point in time. But I also think they need to go 25, because if they don't go 25, then that means that they're really worried, that there's a big, problem out there. So I think if they go 25, the market's going to be happy. Hey, they're listening, but they're not wildly concerned that this is systemic. But beyond that, I think that they can really pause, because I think this is deflationary now.
I agree with you. So the PPI, of course, always precedes the drop in retail pricing, the consumer price index, so inputs. And a large part of that was the cost of eggs. I don't know if you saw that, down like 30% in month-over-month measurement. That's been a big driver of the headline CPI, food, of course, and eggs included in so much of our food products. So maybe that's good news on that front. And then oil, which is integral to everything we purchase and so important in the inflation picture. Who knows, right? We can't tell because we can't get accurate information out of China, and we don't know if they're really coming back, roaring back. If they got the place shut down, we'd almost have to look at satellite photos to see the movement of people in the factories and the places of business, because you can't get accurate info from the CCP.
Yeah, and with regard to inflation, what I would tell you is the number one thing that we think is that consumption has to slow down, right? So, eggs, that was an interesting thing with the bird flu in Iowa, right? That led to the big spike in egg prices. Oil, obviously, the China demand thing is a big question mark, right? You just don't know. You can't trust the numbers there. But broadly speaking, what we do know is that oil consumption over time is going to continue to go up, despite what some of our politicians might let us believe, because of the growth in the emerging world still, right? So there's still a lot of increased demand for a lot of increased demand globally for oil. So the thing that's got to come down a little bit is consumption, and what we've been really steadfast in talking about with clients or at our economic market forecast events is that it takes time for rate hikes to cycle through the system. And, the Fed has been very aggressive over the last 12 months now. We are going to start to see the rate of inflation really coming down. The Fed doesn't need to go another 100 or 200 basis points, right? They need to get it up here, they need to hold, and you're going to see consumption start to get hit. Because more and more people are going to end up with mortgages at higher interest rates with elevated real estate prices, right? That's going to take disposable income away from people. Now with this banking, risk, right? I think people are going to kind of pucker up a little bit and go, maybe I'm not going to spend quite as much money. I'm going to I'm a little bit more worried about there could be a bigger recession. Whether
Yeah.
they're right or wrong about that, it's just what they will likely do. So what you've got to see is consumption start to come down a little bit. And, I think that we're going to start to see that because you're seeing layoffs, you're seeing cost cutting with all these major tech companies and banks. Ultimately, all that cost cutting is just less spending in the economy. It's just going to take time. And we think that as we get later into the year, we are going to see a much more normal inflation number. Maybe not, I still don't think all the way down to the Fed's target, but we're going to be coming down here over the second third of the year here.
I agree with you. Yeah, the target, of course, at 2%. We got Larry Fink. We talked about that earlier at BlackRock, predicting 3 to 4% inflation for, quote, years. And he sends this 20-page letter out, and that's got everybody up in a tizzy on Wall Street especially. And he was a bit critical in his letter of the administration, which I found somewhat surprising, given that I don't think it's a secret Jeremy wants to be Secretary of the Treasury.
Yeah, I'm a little bit surprised by that. I guess he's also kind of looking at the fact that, there's a pretty high probability that the president won't be the president coming up
That's true.
in 2024. So
That's
maybe he
true.
feels comfortable to let it loose a little bit there.
All right, speaking of potential risk also coming down the pike, what about commercial real estate mortgages? I'm worried about the banks holding a good bit of those. That doesn't look good.
Well, yeah. So the CMBS market now, the CMBS market has some potential risk there, right? So that's the commercial mortgage-backed securities market. But
Yep.
the underwriting standards over the past decade have been so much better and so much,
Okay.
you know, the loan to value ratios that when they underwrote these things were nowhere near what you saw back in 2006, 2007 before the global
Yeah.
financial crisis. So I do see a little bit of risk there with the banks, but nothing that is going to take the banks down.
Okay. What about refinancing of some of these loans that just a typical commercial business has, that they took out loans not so long ago at very low interest rates? They got to go back and refinance them. Obviously, the rate's going to be higher. What kind of risk is there?
I think that's part of our case why we see a recession ultimately coming, is that because when people refinance debt, when they're forced to refinance debt at higher interest rate levels, then what you're going to see is less money, right? There's more money going to interest, and that's less money to spend on your business or spend personally. It's everyone had kind of
Yeah.
locked in rates as long as they could. As we get to the end of that cycle where now people are forced to refinance, then you're going to start to see some real economic impacts there.
I know you can't give investment advice here on the show, but in general, what would you say to someone that is looking for some advice or how to manage their portfolio? No secret, you guys do a great job on some of my holdings and appreciate that. But it seems like diversity is kind of the name of the game here, is it not?
Well, so look, this was the number one thing that we said in January at our economic market forecast. We said, look, there's a lot of cross currents going on. It's very difficult to figure out what's going to happen. This is the point where diversification starts to matter, right? Diversification broke last year because interest rates went up. And in 2021 and beginning of 2022, we said, look, rates going up could be the big problem for bonds and stocks. That was our concern. But now we're saying, hey, look, diversification matters. So if you were holding some treasuries or some good investment grade bonds over the past week here with equity markets, going absolutely haywire, then those bonds really bailed out your portfolio. So
Yes.
number one, this is what we put in our client note the other day. We said, look, It's still a bear market. We are not in a bull market. So it is still a bear market. Remember that. You got to be a little cautious. But number two, diversification. And ultimately, this is going to present a lot of opportunities. You just got to be patient right now.
Just as SVB was ultimately taken down by concentration in a single industry, you don't want your portfolio too heavily concentrated in any given segment or investment instrument either. Same sort of concept applies. Jeremy, appreciate you joining us. Very insightful. We'll be talking soon.
All right, Gerard. Thank you. Appreciate it.
You bet. Jeremy Nelson, partner at Element Wealth, has been our guest in the Element Wealth studios. We're coming right back with half an hour and some tickets to give away.